Well, good morning, everyone, and welcome to the 10th Annual Fink Investing Conference at UCLA Anderson. My name is Laurence. I'm the Faculty Director of the UCLA Fink Center for Finance and a Professor of Finance and Strategy here at Anderson. I'd like to extend a very warm welcome to all of you joining us from around the world as we explore some of the most pressing concerns faced by investors today. We have a great day planned, digging into financial markets and connecting with each other in small groups after each session for discussion and community building. We're going to start with three of the hottest letters in public and private markets today, ESG. For our discussion today, we're privileged to welcome three experts on sustainable investing from leading players in the finance ecosystem who are thinking about these issues. Olivia Albrecht is head of ESG strategy at PIMCO, one of the world's largest fixed income managers with over $2 trillion in assets. Dave Fanger is the US business leader in responsible investment at Mercer, the world's largest investment consultant. And Jonathan Posen is head of strategy for sustainable investing at BlackRock, the world's largest asset manager with over $8 trillion in assets. Thank you all for joining us. We are so excited to hear your insights on this rapidly growing field. So let's start with investor demand. The numbers are a bit stunning. Sustainable funds in the United States attracted record inflows from investors in 2020, sort of topping calendar year records from 2019 and 2018, and constituting nearly a quarter of overall net flows into stock and bond mutual funds. In the first quarter of this year, 2021, inflows into sustainable exchange traded funds in Europe overtook all other ETFs for the first time. If you could help us make sense of this, why do investors care about climate and sustainability, and why are they thinking about it more now than in the past? Dave, perhaps you can lead us off. From your vantage point, advising asset owners, what is your take on why we're seeing such an increase in demand?
Yeah, I would say it's really education, really comes down to it. It's access to information, education. So coming from a couple of directions, you might think of it as bottom up and top down. So one thing that's taking place is if you think about consumers, conscious consumerism, citizens, and how they place their votes on what politicians they'd like to lead, even students at universities saying, where do I want to attend? And are they obliging to these environmental and social issues? So there's a voice that's taking place, and it's because, if I held up my cell phone here and saw it through the virtual world, that access to information is in front of all of us. So we're seeing everyday headlines, social and environmental headlines, and we're taking a call to action. What are we going to do about this? Using our voice. So I think that's more the bottom up part. I think on the top down part, we're seeing now politicians who are listening to the climate science. They're hearing the social issues in their communities. So they're also taking action. So you've got this mixture of two worlds, but it all comes together because of the access to information, and that's being put to work. It's being put to work by the voices of the consumer, the students. It's being put to work by the participants of public pension plans and corporate pension plans. And then we're seeing it at the top down. Governments, over 100 governments committing to net zero. I mean, that's an astonishing number that's taking place there. So I think in total, it's all about what we all already know here at the university. Education is so important. And what are we going to do once we have that education?
Thanks, Dave. Olivia, how is it playing out in the fixed income space? What is driving demand there?
Yeah, I would fully share Dave's view of the world, which is that there are a confluence of top-down and bottom-up factors that are driving investor demand globally. I'll lay out a few more perhaps than Dave mentioned to supplement his comments, and then make some observations about fixed income. But I think for me, all of this comes down to the recognition that finance can play a role and drive impact. And I think that's an important recognition that's driving so many of these top-down, bottom-up forces that are creating this confluence to drive so much interest and so much assets into sustainable investing. So when I think about some of those trends, certainly from a top-down perspective, there's a lot of regulatory pressure that's coming on board that's driving forward more interest in and asset growth in sustainable solutions. Most particularly, as all of us know, the EU is very much leading the charge. And from Brussels, we have new regulation from the SFDR to other taxonomies. It's really driving from a top-down perspective so much growth from the European side of the equation that's driven from regulation and policy. I would say stay tuned in the US to see what will happen from the SEC, from the Department of Labor, from so many other entities across the US, where there will likely be changes and pressure from a regulatory perspective here in the US as well. So certainly some of the trends have been driven from top-down requirements and policy and regulation, but also from an investor perspective, end user investors, as Dave was suggesting, driving so much interest in sustainability and sustainable investing, with the recognition through education that their assets can make an incredible difference in driving forward a path to a more sustainable economic model. And we see this through enormous commitments to things like the UN PRI, which now tops well north of $70 trillion of assets being represented by asset owners having signed on to the PRI commitments, or as Dave suggested, net zero commitments globally, now topping $37 trillion of assets that are committing to these net zero commitments. So just incredible interest from the investor side of the equation as they recognize that their dollars make an incredible impact in the direction of travel for the global economy. Also from a bottom-up perspective, I'd highlight a couple other areas as well. You know, certainly from a consumer demand perspective, consumer preferences have changed. They are changing the way businesses operate, the types of products, the ways products are built, the ways products are distributed is being impacted from these shifting consumer preferences. That's another critical input into this trend as well. Last one that maybe doesn't get as often communicated about would be talent trends. Where do people want to work? They want to work at companies that have sustainability as a core part of their business model, that recognize that there's a multitude of stakeholders that are critical to business models and not just shareholder optimization. So that hunt for talent is going to be critical as you think about what the competitive edges are for different companies around the world in order to attract and retain the next generation of leaders. So again, confluence, you could keep going on and on about different angles, credit rating agencies that have taken account of ESG factors, that's driving cost of capital, that keeps CFOs and corporate treasurers up at night to think about how their activities on sustainability impact their ability to finance their business operations. So a lot of different factors, top down, bottom up, driving this massive confluence of intersecting kind of interests here. And on the fixed income side of the equation, I just think the recognition that we as bondholders in a very, very large part of the capital market system have a role to play, have an important role to play. And we get the luxury of having things like green bonds, social bonds, sustainability linked bonds, which creates a real natural asset class for us to invest in to really showcase the impact of some of those dollars invested. So thanks so much for the question.
Thank you. Thank you for the answer. John, would you add anything? What are you seeing from your fairly wide array of clients?
Yeah, I agree with everything that Olivia and Dave said. One thing I would add is over the last few years there's been a fundamental change in the way that investors have thought about climate change. For a long time, it was recognized as something that was important to address, but it didn't necessarily translate into investments. For the last few years, people have investors specifically have recognized the mounting impact of physical risk on investments. And they have also recognized that along with all these net zero commitments and commitments by individual industries, the ways that the economy is going to fundamentally change. And that means that the value of their investments today might not be valued in the same way that they would have done it 5 years ago. So people are really changing the way they value investments due to climate risk and due to action by government and industry that we're going to see over the next several decades.
So ESG, of course, refers to really a broad variety of factors that are distinct and also sometimes overlapping. What do you find is the distribution of attention to E, S, and G factors in your client dialogues? Do you find that these preferences vary regionally? And how do you find that E, S, and G factors are interconnected with each other?
So I guess I was the fastest to get off mute, so I'll start. I'll make some observations. So first off, governance is the bread and butter of good research and good investment decisions. So, governance is something that you have to, as a quality investment manager, you have to look at. It's nice and neat that it fits into this ESG framework, which is somewhat new in the context of the investing landscape. But, from a concept perspective, governance is something that we as stewards of capital have looked at for many, many, many years, right? What's new, I think, is around the environmental and social data sets and information that we're receiving from companies and issuers around the world. There is an interrelationship between some of these factors, but it's important to recognize that they are distinct. And when we do our own analysis, we're not looking at trying to create an aggregate ESG score right off the bat with a municipal bond issuer or a securitized asset or even a green bond itself. Rather, we want to look distinctly at the environmental pillar, the social pillar, and the governance pillar. And yes, you can aggregate that up into an ESG score, but they are distinct areas of materiality that you would be evaluating. I want to make one observation in terms of investor trends, because I just find it so fascinating to see how quickly this movement has pivoted. I would say, as a broad observation, the focus around climate has been very distinct and very powerful over the past several years. So much of that is driven by the TCFD, Task Force for Climate-Related Financial Disclosures, which has finally created kind of a harmonized system for companies and issuers around the world to disclose information to us as asset managers for then us to consume to make better investment decisions on behalf of clients. So much of the climate focus has been driven by support from a harmonized disclosure program, and that's wonderful. But we haven't had that same disclosure program rolled out or built in social factors, which I find interesting, and I suspect will be the direction of travel over the next, say, 3 to 5 years, or something that I hope will be the direction of travel over the next 3 to 5 years. But I was surprised by how quickly in 2020 we saw large asset owners shift their sustainable investing program from a central focus on climate risk reduction, climate solutions, and a greening of the global economy toward more of the social factors. They were really looking very quickly after the events of 2020, and gosh, there were so many events of 2020, it's hard to recall where we started all the way through where we ended in terms of very highly unusual and once in a 100-year events that happened over the course of 2020. But very quickly, they started to focus on social equality, community impact, racial equality, gender diversity, all sorts of different, more socially oriented factors. And I was surprised particularly by the US multinational cohort, so companies that are headquartered in the US, but with global presence as large household names. They quickly started to orient their investing interests toward more of the community and social impact side of the equation. So I think, more to come with social. It's always important to remember that S technically is at the center of E, S, and G, but it hasn't gotten the limelight that I think that you've seen so far with climate and E in particular.
I think one of the things that Olivia touched on something important was the materiality of different categories. And one of the things that's important to us when we're evaluating investments is that we're not using a blanket approach for ESG, but even within that. So let's think about water usage. Water usage is going to be very different for a power company than it is for a consulting firm. And so we make sure that we're looking at the materiality of different ESG factors by sector. Another thing I just want to add is that we're increasingly seeing the ways in which things like E and S are interrelated. So let's talk about Los Angeles for a second. South LA has significantly fewer trees than richer parts of LA. That means less shade, it means greater heat, it means the air is dirtier and it's hotter. And so as climate change worsens, you're going to see an even more exacerbated form, lower productivity, worse health outcomes. And so it's important that as we think about how to transform the global economy, that we are not isolating E and S from each other, but thinking of them together.
Yeah, I was going to add in too, also regionally, what we see from a global perspective, it's quite interesting working on a global team on sustainability, because we'll see in Australia, there's regulations in place on modern slavery. So if you want to talk about S, you might see a major client demand taking place in Australia. Whereas if you go into, let's say, Europe, like we talked to before, the new taxonomy, the SFDR, there's a lot of focus on climate, and I guess social is part of SFDR, but a lot of heavy focus there on the climate, so the E part of it. So we do see regionally these differences taking place. And then I would say we've all learned, from 2020 and 2021, how S has come, I love how Olivia said that, it's at the center. It's really become the headline that we need to address in the US particularly. So I think that's what we're seeing as far as client demand. It's both on the environmental and social side. We see a lot of net zero campaigns taking place, a lot of client demand for that. And, I like to look at it overall, like similar to how we see it in finance. We learned about covariance matrices or correlation matrix. It's the same thing in nature. If we're going to have a sustainable planet and a sustainable society, you have to look at it in the same way. Nature is a correlation matrix. You can't just move one part. They all are interconnected. So same thing here as we think about environmental and social topics. We've done some work with the World Economic Forum on this to look at these systemic risks and how they're integrated and interconnected. And that's the pattern we see. So when we're talking with a client about how can they implement, let's say, the Sustainable Development Goals or these major factors, it is a discussion. It's an education, going back to education, to say, look, this is how it's connected, and you can't just move one variable or one portion of your portfolio to hit a net zero target. You actually need to consider the S issues as well. And one powerful stat I recently came across, this was from the NAACP, saying 68% of Black Americans are within 30 miles of a coal-fired power plant. They've either lived or, in the past or live there now. So you can start to see why there's high asthma rates from emissions, from pollution in these areas. So just a quick fact, but these are the things that we'll spend really the beginning step before it even gets to an investment policy, before it gets to an investment solution on how do we get to a low carbon portfolio. It starts with a boardroom of these trustees and education on these sustainability topics.
So, some critics call this a green bubble. What would you say? Is this trend itself sustainable? The sort of increase that we see in investor demand, is that a sustainable trend? And how are your firms thinking through and really kind of planning for whether the rise in investor demand that we're seeing for ESG is temporary or actually part of a paradigm shift?
I'd love to jump in here first.
I'm not surprised.
This year, one of the things that we did at BlackRock was to take a look at our capital market assumptions, baseline assumptions about how the economy is going to change, what different asset classes are going to do. But this year, we integrated climate considerations into those assumptions. And one of the things that process bore out was the belief that we could see as much as 25% in cumulative gains over the next 20 years from a climate action scenario versus a baseline no climate action scenario. So we think just in terms of economic growth, transforming the economy is going to be essential. The other thing that is often not absorbed is the degree to which economic change really needs to happen. It's not just about selling lots of new electric cars. It's also about replacing those cars on the road. So there's a tremendous amount of turnover in the economy that has to happen. And we expect to see significant investment in the climate transition.
Olivia and Dave, are you seeing something similar? What is your viewpoint?
Yeah, happy to make some observations. before I make some observations, I always think it's really important when we're talking about ESG and sustainable investing to bifurcate between two worlds, because your answer to this question is going to be dependent on how you think about these two pillars of ESG. We call it our ESG platform. I think of it as sitting on two pillars. The first pillar is ESG integration. This is how are we as stewards of capital ensuring that we fulfill our fiduciary duty to clients to look at every risk and opportunity, both from a bottom-up perspective when we analyze individual investments and thinking about it from a top-down perspective, as John was indicating. How do we incorporate climate risk into our macro forecasting? How do we incorporate income inequality into our macro forecasting for key regions and countries more heavily impacted by income inequality or social inequality within their jurisdictions, right? It's our duty to look at these, what have historically been seen as non-financial factors in environmental, social, and governance. And how do we do so in a consistent, formalized way? We are not fulfilling our fiduciary duty by turning a blind eye to a set of data that is material, can be material, and is impacting pricing today. So the first pillar of work for ESG platforms has to be about ESG integration. And that's about getting better information and more informed investment decisions from your analysts and portfolio managers around the world. The second pillar is different. And this is about building solutions for clients that want more than just ESG integration. They want climate solutions. They want ESG best-in-class investment decisions. They want community impact. They want a focus on racial diversity within their investment strategy. So if you kind of think about these two pillars as separated, there is not a state of the world that I can see where ESG integration isn't part of the asset management community, period, full stop. I don't see that world happening. I don't see a world in which, thinking about how climate change, the physical risks of latitude and longitude of an investment decision that you're making on behalf of your client's assets for 30 years in a commercial real estate property won't be important. Now, their second pillar, you could make a case that says, well, maybe clients will feel so comfortable with what you're doing in ESG integration land that they won't need dedicated solutions for, a climate-focused portfolio because they know there's so much climate work that's going on in their existing portfolios. I could see a state of the world where that might happen. I always like to think about it as, the expectations for ESG integration exist from global asset owners around the world. That's very clear. Then there's a subset of clients that want more than ESG integration. They want solutions that are ESG labeled, high quality, Article 9, if you want to speak SFDR language. And what you'll see is over time, the next 5 years, you'll see both expectations increasing. And there may be a point in time where you look back 5 years from now and you look back on the ESG integration pillar and you say, gosh, that looks a lot like what you were doing 5 years ago for your ESG labeled funds. But I think also in that process, the BlackRock ESG fund solutions, the PIMCO ESG fund solutions will just keep increasing in terms of the quality of output they're providing on all of these environmental, social characteristics. So my state of the world is that both of these pillars coexist and that the expectations for both of them increase dramatically over time, such that you might look back and say, gosh, what you do in your traditional portfolios today look and feel a lot like what you used to do 5 years ago.
Maybe I'll add on to that. When you first said green bubble, I was thinking, when have we seen past bubbles, right? When has a price been so far greater than our intrinsic value? But you look at a green bubble or even a social bubble, however we want to call this, you got to look there and say, what is the intrinsic value of harnessing the power of solar and wind? What is the intrinsic value of reducing inequalities, providing access to clean water? All of these sustainable development goals that we're so far off right now from even accomplishing. So to me, we've got a long way to go to solve these things, and we're all going to be a part of those solutions. So that's where I look and say, wow, that intrinsic value is so great that the price just hasn't gotten there yet on it, so that there's quite a bit there to still solve. But I think that's the exciting journey on going after these sustainable development goals that we can all be a part of, whether we're investing or we're consuming goods with it.
So you started to touch on sort of how all of this is driving product innovation and portfolio construction. Investors, as you described, are sort of attracted to the ESG approach for different reasons, right? Some want to do good, some want to reduce harm, others view it as a means to mitigate risk, so to the ESG integration point. But all ESG investors in that overall bucket, regardless of their motivation, do want to earn a financial return. So do you think do you see a trade-off here between financial return and sustainability goals? And do you find that your clients would be willing to accept a lower financial return in pursuit of their goals?
Yeah, maybe I'll go first since I'm already off mute here. No, I think one of the key things we're addressing with clients across the spectrum, they could be asset owners of many different types. It could be an endowment, a foundation, a corporate, a public pension. They're all looking from a fiduciary lens. So in their means of making decisions, they're going to be looking at what is the economic interest of those of the plan that they're working for, those trustees. So from that perspective, at Mercer, when we're walking through this, with a client, and I was talking about the educational component of it, it is addressing those E and S and G factors from a pecuniary nature to say, are these materially important from a risk return perspective? And then it might be pointing them to solutions. So if we're working with them on a low carbon transition portfolio, we'll use tools to identify where we think there might be areas where they could reduce emissions. Could be a given sector or sub-industry, but we'll walk through some of the literature on it. What have we seen from recent performance on it? And then, if they want to implement something as far as a given fund from, whether it's one of our other, members of the panel or many other asset managers, we're then looking at the financial perspective from basically there's a financial rating that Mercer puts on different strategies and different asset managers. So we'll look at it through that lens to make sure we're addressing the economic interest. But then we also have ESG ratings. So that's an entirely different diligence process that we conduct to ensure that a given strategy or a given manager is taking into account in their ways they're coming up with ideas, how they're managing portfolios, or even how the business itself is dedicated to integrating ES and G. So they really come together nicely so that at the end of the day, this myth of sacrificing performance is being removed. It's really focused on there is performance and how do we find those managers, those strategies that are providing that with environmental, social, and governance in mind. I'll just add too, you'll hear some folks talk about impact investing, and sometimes there's different definitions there, but that's where you might see a given foundation say, I'm actually willing to sacrifice performance if I want to go after my mission-driven investing on an impact side. So sometimes we see it there, but I would say we've really got to watch, especially in the US with the DOL around ERISA fiduciary status and ensuring that it's in the economic interest of those plan participants. But as we've been talking today, so much has come out that these are material factors. These are pecuniary factors like environmental climate topics. And so you're seeing more of those headlines come about as we go through 2021 from the SEC and the DOL.
Well, so kind of, Olivia, would you want to add?
Sure, I'm happy to offer some comments as well. Look, this is the, I don't know what price tag you want to put on it, the $1 million question. And Lori, this is so much of the work that the academic partners can really help us with, which is answering the $1 million question, which is there a performance trade-off? Now, the good news is that academics have been very busy over the past, say, 3 decades. I think there have been something like 2,000 plus academic peer-reviewed papers that have looked to answer the question, is there a trade-off, or what is the relationship between ESG and performance? And, when you look at some of these meta studies out there, you see that over 90% of those academic peer-reviewed papers show that there's no performance give-up. Some show that there might be a positive correlation between performance and ESG factors from an investment style perspective. Others show that there's a neutral outcome, but less than 10% show that there's a performance give up by automatically thinking about or building an investment solution toward ESG. That said, taking a step back, I mean, you're certainly hearing a little bit from the three of us today, there's no one size fits all to ESG investing. So answering that question is a very narrow question for something that's as complicated as it is. I mean, as Dave was mentioning, there's impact investing, there's negative screens as a strategy, there's climate orientation and low carbon solutions. There are different asset classes that you can invest in with an ESG lens or style. So it's very difficult to say, with a holistic statement that ESG investing results in X outcome or Y outcome. It's no one size fits all approach. Is it style? It's an approach. Some managers do it well, others don't do it as well. Some managers use certain data sets, others managers use other data sets for their strategies. So it's a complicated question. I think that it's our responsibility as asset managers and consultants to be transparent with asset owners about what the potential impacts of their decisions for their investment strategies might be. And I think as long as you're clear about the potential scenarios that could play out by excluding the fossil fuel industry or excluding parts of the market, that most clients seem pretty satisfied with a transparent conversation around what are potential trade-offs. And I think it's our responsibility to be clear about that. And then again, you kind of look at where the direction of travel is going, which is, the global economy is changing rapidly. It is critical for BlackRock to incorporate climate into their capital markets assumptions. Even when you look at some of these studies, they're all backward looking by definition, right? Nobody has the forward looking scenarios and the forward looking studies to conduct. So I think when you think about that, you kind of say, the direction of travel, the global economy is changing so much. So don't put too much stock in the backward looking studies and data, and really think more about what is your intuition about what the direction of travel looks like. To run a study and say that excluding oil and gas from a portfolio over the past 30 years would have been negative to performance. I don't know, is that indicative of where the next 30 years is going for the fossil fuel industry? Probably not. So don't put too much stock in some of those backward-looking studies. Think about what is your intuition about what the future state looks like and where the economy is going to better assess what the potential trade-offs are.
Mm-hmm. Well, so speaking of sort of not having a one-size-fits-all solution, let's talk about measurement. Central to pursuing sustainability goals is accurately measuring sustainability, right, across all these material E, S, and G factors. And investors need comparable and reliable metrics to make portfolio decisions that deliver on their sustainability goals and avoid greenwashing, if you will. Can you, and Olivia, you started to sort of shed some light on the regulatory environment, but I wonder if we can sort of bring us all up to speed on where the regulations stand right now around the world. As you said, the EU was sort of leading the charge here, that the US is a bit behind. So specifically in the US, looking ahead, where do you see the regulatory environment moving to help kind of standardize some of these metrics so that investors have consistent reliability?
Well, unfortunately, I don't have a crystal ball on this either. So I'll make some observations about global trends and then some things that we've heard in terms of policy agenda. And I would welcome John and Dave's perspectives here too. And I'll busily take notes for their comments as well. But yeah, from a global regulatory perspective, look, for the past several years, the EU has been out in front in terms of their ambitions with the sustainable finance disclosure requirements. And the taxonomy that they have built out. So certainly kind of forward-looking, when you look at the fund landscape in Europe, I was really taken aback by a study that came out from PricewaterhouseCoopers in Q3 of last year. They predicted that by 2025, which frankly is not very far away, so that's T minus 4 years, they predicted that by 2025, you would see over 50% of all European domiciled funds would be ESG. Over 50% would be ESG funds by 2025. So what's driving that? I mean, a lot of it is going to be SFDR. BlackRock has great ambitions. So many of these asset managers have great ambitions to transition most of their European domiciled funds toward Article 8 or Article 9. Think of those as kind of ESG funds. in regulatory parlance. So this drive toward, moving the investor base into, clear taxonomies about what is an ESG fund and what is not an ESG fund, that's a clear direction of travel from global regulators. I think the work that Dave has to do and the asset owners around the world to sort out what is the difference between one ESG fund and another ESG fund. They both are called ESG funds, but the styles and approaches are different. This is hard work, and asset owners need support from regulators to help differentiate and help have a common taxonomy for what is and is not labeled ESG or sustainable or impact. So I think that there's a clear focus from regulators on that side of the equation. Another side of the equation, and as David mentioned, Australia. I mean, the regulators in that part of the world have already kind of moved toward required disclosures around climate. I think from issuers, I think that that's a natural direction that you could see, which is more and more expectations for climate factors to be incorporated into required disclosures from companies. That seems to be on the table as well. So I think a lot of different angles, so much focused on the asset management community with respect to fund classification and taxonomy, clarification of labeling. So in SEC speak, that would be a names rule for when and how to use the ESG terminology or any of the kind of derivations off of ESG. And then lastly, in terms of required disclosure or strongly encouraged climate disclosure, I think are three topics that seem to be front and center for global regulators today.
Go ahead, Dave.
Yeah, I was just gonna say, when we think about, what has been mentioned by Olivia on the EU taxonomy and SFDR, this is really about getting that information, access to information again. It's how do you get consistent definitions, consistent disclosures, and get that across all bodies, all organizations. You might think back to, before we had access to even information through Bloomberg terminals or financial accounting standards before they existed. These are things that have helped us understand the value of, the things we're doing, companies, products. But that's what we need here on ESG. We need some definitions set up. We need consistency on the disclosure. So that's why the signposts are really over there in Europe, because they're putting these into place. The regulations are saying now, look, we need to earmark or define what is Article 8 and Article 9. How are you integrating ESG? Is it part of the objectives? Is it the focus? And then how are we going to disclose? So one of the more popular frameworks that's being used out there is the TCFD, the Task Force for Climate-Related Financial Disclosures. So that's going to help us disclose consistently across the same types of definitions. And it's using things we're familiar with, like the GHG protocol. So how are we going to define and use the dominant accounting standard for emissions from a given company? So all of these things, as they become more consistent, and as we disclose more of it, it'll just help us understand then that question that you had before, where's the performance at? And really to get to performance, we have to understand, going back to that intrinsic value, how are we adjusting the cash flows based off of environmental and social information? So yeah, it's important that we get these frameworks out there. I would say too, we didn't talk about like the SASB, the Sustainability Accounting Standards Board. That's another way of looking at and greatly a number of factors. They map to the SDGs, they're defined, they can be measured, environmental, social, and governance topics by industry. That's a great framework. And then thirdly, I'll say on the impact side, we see a lot of demand there from clients that are impact focused. And those are frameworks that many are trying to solve, whether that's, GIN as an organization, there's the IMP, they're looking at frameworks. You've also got IFC out there that's got operating principles for impact and their own measurement and monitoring framework. So we're trying to help clients understand what are the frameworks, how can you use them, and some even curate their own. So there's a lot of good stuff to come there, but we definitely need to draw up and really ask of everyone to use these, consistent definitions and disclosures so that we can really understand and make decisions upon that.
Olivia and Dave both spoke about the issue of disclosure. And it's really essential. We think that climate disclosure should be mandated because it's essential. It's an essential piece of information for investors to calculate the long-term value of a company. But it's not the whole picture. As everyone at Anderson knows, you can look at someone's 10K, and that's not everything. You have to then do your analysis with that information. And so what we're seeing now is a real race to build out the climate analytics, the sustainability analytics at investment firms, so that starting with this essential baseline of TCFD disclosure or other sustainability disclosures, you can take that, but then you can also bring in proprietary analysis, other data sets, and build it out into a really more fulsome picture of a company's value based on what we're seeing in climate change, in other sustainability trends, and economic growth more generally.
Thanks for all of those insights, and just to build on the last point. I mean, it is true that the oversight is essential to building a mature ESG sphere, but you all have the unenviable position of having to make decisions now. When the disclosure environment is not complete and it's not mature yet. So as things stand, what data? So John, you pointed to sort of building out analytics and tools. What data sets are all of you using, and what tools are you developing to identify and assess ESG factors? It seems really hard, right? It seems to be much harder in practice than in principle to determine when a company or an issuer, more broadly, is ESG friendly. So if you can tell us how you're working to overcome these challenges, how do the data and tools vary across ESG factors? So, social factors versus environmental factors, maybe even emerging economies versus more developed economies. And what do you think will help drive sort of higher quality data and higher quality tools? It's kind of any part of that you want to tackle, all of you.
There's a lot there, a lot of good stuff. I mean, it goes to data vendors that are gathering this information. Goes to the accuracy of the data they're collecting, and then we're relying upon it. So a lot of that is what I'll call more kind of the reporting or monitoring. Separate from that, I would say, how we look at more of a forward ESG view of an asset manager's strategy or firm. How are they using some of these tools? How are they engaging? Engagement is a major part of this. What are the processes in place? How are they communicating within the firm on these topics? So a lot of that isn't necessarily data gaps or how they use, let's say, specific vendors, but it's more how are they generating ideas that can add value as far as performance, and how are they implementing processes and part of their culture as they think about ESG integration. So there's a couple of parts to that. So we complete diligence on thousands of firms and strategies that relate to that. But I'd say on the data side, we get a lot of interest here because clients, they're getting pushed to say, report on this. We talked about disclosure, some of the requirements to disclose on these topics. But then we've got clients who want to report on, let's say, impact. And it's one thing to go out and get that data on listed equity and fixed income and sovereign debt. It's another thing to get it in private markets. It's not as developed. And if you think about some of the topics, it's one thing to go after carbon emissions, but there's a range of factors to cover on the S side of it. And so you've got to go out there, and we've diligenced last year. Gosh, it was probably over 20 data vendors, that Mercer was looking at as far as how do we get to that data so that we can report on and guide our clients on it. And so sometimes they're boutiques. They're focused on one thing. It could be just on gender equality, and that's a data vendor we would use. Some of them are quite developed and can cover all of those listed securities out there. So there's some major players in the data world on that we'll use. And then I would say sometimes we get to more of those emerging markets where we're looking for that same data, but it's not there. So we've got to use more of a manual effort. And that's where, for us, it's a great network of the asset managers that we know. So those asset managers can then go into their respective areas and ask for, under some type of a template format, very similar information. It's quite manual, but that's how we're able to do that. We're able to go to an asset manager, work with them and say, we really need to find this impact information. and here are the measurements we need. And so that's the great part of this, is you've got a collective effort taking place from Mercer's broad presence to the asset managers and their broad global presence to really capture data, pull it all together, and get back to these disclosure frameworks so that we can help clients make those active decisions.
Well, let's ask the asset managers.
Well, maybe I can make it a positive spin just to start off and then dig into some of the challenges. First off, challenges there might be, yes, of course, but gosh, way easier than where we were 10 years ago. The data was even less consistent, was less formalized, fewer vendors and data providers than Dave was mentioning 10 years ago. So we've come such a long way, and bless you, John. We've come such a long way over the past 10 years. I suspect over time we'll move very quickly to more consistency, harmonization, and quality of data coming from providers, which ultimately comes back to the issuer side of the equation, right? There needs to be more consistent disclosure from companies, municipalities, governments, in terms of providing us as asset managers with the right inputs to then aggregate and create templates that output to Dave's world. But it's all, quality input in, you get quality output on the backside. But I think if you were talking to policymakers and providing advice and thoughts, right, the observation would be, we need better information from the investments that we're making, from companies, from governments, et cetera. And then that helps us create better outputs and helps the investors have more informed decisions about what how their investments are potentially making an impact. So good news is we've come a long way. There's a long way to go. Yes, of course. I think that the attitude that I think one has to take is what Dave said, which is it has to be a triangulation of data sets. There's no one data provider that's going to give you everything that you want to know. I want to work with a boutique research provider that knows longitude and latitude of commercial real estate. That's super important information. Is that the only information I want? No, absolutely not. But it's a good starting point, and I want to input that into my own system, my own applications as an organization that then informs my portfolio managers to make better investment decisions and allows me to report out to regulators and clients the right information. But we need so many data points like that I think of it as like a patchwork or quilt of different data providers that kind of come together into an aggregated system. And that's often what's the secret sauce at each of these asset managers, is the compilation of these different data providers from a bottom-up perspective. And, understanding when sometimes the data from one provider should be overridden by insights from your own analysts, insights that we have that may be different from third-party providers, and that's okay too. So it's complicated. It's a quilt. You got to pull in lots of different data sets, lots of different providers, lots of different raw data from those providers to create your own kind of evaluation and view of the world. And then the last comment would be fixed income as an asset class is just so complicated. When you think about ESG and equity, you can kind of get your head around it. These are companies, generally, publicly listed companies that you're taking equity positions in. You can kind of understand what you're going to get in terms of the data and how to evaluate those companies. Of course, you're going to have different sectors and industries and frameworks of what's material for those sectors. But what's different about fixed income is corporate credit is just a piece of the puzzle. We have all sorts of different types of asset classes to look at, from municipal bond issuances to securitized assets with ABS, RMBS, CMBS, CLOs, everything in between. We have sovereign issuers. We have green bonds, social bonds, so looking at individual bond issuances. And then, of course, we live in this world of derivatives as well. So you have to have some sort of waterfall logic for how to evaluate ESG factors across the derivative space as well. So the data is critical. We take input from issuers. That needs to be high quality, more consistent, harmonized. Through that process, then we can aggregate a lot of different data sets into our own applications and systems that create more informed decisions for our clients around the world. And then just this recognition that in the fixed income landscape, it just spans so many different types of issuers, so many different asset classes that you have to be really thoughtful about ensuring high quality data across all of those asset classes.
Oh, I could add something, but I won't say it any more eloquently than that. So we can move to the next question.
Well, thank you, Olivia, for that, and Dave and John. And you raised an interesting point, Olivia, about sort of the potentially added complexity in fixed income around these issues than we have in the equity space. And right now, annual shareholder meetings are ramping up. That season is getting into full swing. So engagement and stewardship are top of mind for a lot of investors and for investment managers. As you said, in fixed income, there's such a broad range of issuers, from firms to municipalities to countries. And engagement is an ongoing concern with potentially added complexity. So I'm curious for all of you, both sort of in fixed income, the equity space, and spanning all of it, how do you approach engagement, and what are the challenges to persuading issuers to change practices?
So at BlackRock, we view this as an essential part of the way we manage climate risk on behalf of our clients. We engage extensively with companies from all sectors. Around sustainability and climate specifically, we've identified a focus universe of companies that produce a significant amount of the world's emissions. And what we're doing with them, we have asked all companies for their plan to transition to an economy that limits global warming to well below 2 degrees. Along the lines of the Paris Agreement, and with this focus universe of companies, we're really digging into that plan. So it's not just about whether a company says, "Okay, yeah, we got a plan, we're going to do it." It's much more about understanding what is that path, what are the actual steps you're going to take. So for an oil company, for example, if the world is net zero in 2050, what are the steps you are taking to transition your business model so that you will still be a functioning profit-producing company decades down the road?
Yeah, I think for Mercer, as we're educating the clients on different approaches, it goes back to, I think, a common theme we've heard today. It's not a one size fits all. There are many approaches here, and it's going to take everything we've got in our tool shed to fix all these sustainability issues. So engagement is a key one. And you heard John here mention. There's participation in collective events like collective groups like Climate Action 100+, where you're going after, engaging together, and trying to address top emitters. And there's many other organizations out there that cover environmental and social issues, but together, everyone can really bring in that voice and engage. And that's part of our education component. There's academic papers out there that have looked at, has engagement been successful? And you can point to many papers that it has been. So that's another approach. It's not just about, how do I go after thematic impact opportunities there to find performance. It's not just about how do I screen and divest from maybe fossil fuels. It's really, we call it decarbonization at the right price. When we're looking at a portfolio at Mercer, it's going to be, let's use this tool. We have a tool out there that's kind of looking at, let's say, low carbon transition. And there's other tools out there, but it's trying to look at both how can we look at those who are emitting, and how can we look also at where there's green opportunity. So the portfolio can have both of these things. So that's how it's getting to this optimal solution on how can we reduce the emissions out there, but really trying to address the end need for the clients while we think about their fiduciary duty to really do the best, economic interest they can for those plan participants.
Maybe the only other observation to make and echo and reemphasize the comments from Dave and John in terms of the importance of engagement, the opportunity for value creation through engagement activities, also the potential of coordinated, collaborative engagement, I think is super powerful. John, since you're the largest in the group, I mean, $8 trillion is very large. But imagine that we add ourselves together and we get, north of $10 trillion of assets when we come to an issuer, engage with them and say, here's $10 trillion of assets, and we're speaking with one voice, and we want to see a certain outcome or a certain focus from your executive management team or your board in terms of strategic priorities, because we think it's very important. I think that opportunity for collaborative engagement is really powerful. My only other observation would be from a fixed income perspective, which is, I think that there's a lot of engagement that we can do, and this has been a big focus for us at PIMCO on some of the more nerdy aspects of engagement, which is I want to see from issuers that are bringing a green bond to market certain protocols for how that green bond is disclosed, the projects and activities that are being financed, the ongoing reporting and disclosure that we would expect as investors. We want to see kind of compliance with international standards for how to bring those bonds to market, how to continue to inform investors about the projects and impact that are being financed through the green bonds, social bonds. So we do a lot of behind the scenes activity before bonds come to market, where we'll offer insights for what are best practices and get more into the technicals of the issuance itself. I think that's an important engagement activity. I see it a little bit as a public good. So the more we engage with companies and help bring higher quality issuance to market, all of us here today benefit from that activity. And I think that shared standard is really important to help create a more high integrity, high quality, and more sought after bond market. And no surprise today, you see the green, social, and sustainability linked bond space at more than $1.5 trillion behind these types of securities. That's up from $0 15, 20 years ago, and at a pace where you see $500 billion of issuance every year. And some are estimating that in the next several years you could see $1 trillion of issuance every single year. This is becoming an asset class in and of itself, and we need to ensure the integrity and quality of this asset class, and that's part of our responsibility, and that's an area that we want to be actively engaged in as well.
So we have time for one question from the audience, and it relates to two mega trends that we're seeing, ESG and crypto. And they seem to be on a collision course in the sense that the energy production requirements around mining Bitcoin or other cryptocurrencies seems to be at odds with environmental impact. Would any of you like to comment on sort of how you see these two trends sort of reconciled with each other, or any comment on how they're intersecting or colliding?
I guess maybe the question of the audience is what coins are they owning out there, Doji or what's happening there? I think it's a mixture of, again, performance questions. We've seen some about the inflation interest, like if inflation goes up, is it protection relative to other forms like gold? I've also seen some research and write-ups on this where it'll touch on, yes, they're energy intensive. And then you'll see things about mining for coins that are green related mining. But I think the one relative research report I saw on it was, looking at mining crypto, mining these coins versus mining gold. So if you think about the two forms of currency that you're investing in, and then what's the energy that you're using to mine one versus the other. So some of these, as we go to kind of this net zero topic, whether it's a stock, a bond, it's becoming relative as to where can I reduce emissions early, and where later, as we get into other forms of carbon capture and storage, can I start to think about reducing emissions there. So it's part of a large topic, but yeah, there's a lot of good things to read about on the topic out there. So I'd say, make sure you're educated on it and see where these coins are really using that energy, and think about it on a relative basis as well.
So education, right, Dave?
Absolutely.
Love it. So just to close and wrap up, summary thoughts. When we think about the future of sustainable investing, what are the few sort of keywords that capture what we should all be paying attention to and sort of tracking as we follow this trend? And you could have the same keywords, all of you. I'm just curious.
This is not a great keyword, but I would say change. And what I'm getting at there is that we have a set of assumptions right now about what's going to happen with climate and what is going to happen with government action around climate. That is going to change rapidly with each year as we are either meeting or not meeting the temperature goals that the world has set, as climate change becomes more dramatic and starts to mess with the climate models that we've set, and also as people begin to experience both greater physical impacts of climate change, but also the financial impacts of all these stranded assets that are going to start being turned over. And so keeping in mind that the world is going to look significantly different in 30 years because of both climate change and climate action than it does today.
I'll close optimistically and say, opportunity. There are huge changes underfoot. There's incredible investment opportunity. Yes, it's our duty to look at the risks, but it's also our duty to find the opportunities. We'll do that. There will be plenty of opportunities. The global economy is going through, the fourth industrial revolution, so to say, right? We're at the brink of massive changes to our economy. If we do this right, there will be winners, there will be losers. Avoid the losers, find the winners, but don't forget, stay optimistic. There's tons of opportunity out there.
I'll probably go with the UCLA Anderson tagline, think in the next. Kind of goes with what we're saying here. Be ready for change, be ready for blue oceans, and we've got a paradigm shift happening with sustainability. So a lot of opportunity there. So think in the next.
Spoken like a true alum, right? So on that very positive note, I want to thank you all for this very fascinating discussion, and thank everyone in the audience for joining us. A big virtual round of applause for our panelists. Thank you so much. And to everybody in the audience, we invite you to continue the dialogue and discussion with each other. You can follow the instructions that you'll see popping up right now to enter breakout rooms to sort of meet other people who attended this conference and keep discussing these issues. And after that, we will come back later for our second panel on equity markets today.